Good day, everybody. Jeffrey Beamer here, Senior Investment Strategist over at ewotrading.com. We are coming to you today on a Wednesday, June, what is it? The 12th. I had to look. And we come with more earnings discussion. You know, we talk about two sides of earnings. There's stocks that break out and have big moves, and there's stocks that consolidate and they're quiet through their earnings cycle. These are two distinctly different patterns, and we look at two completely different strategies to trade them. So today we're going to look at the breakout side, okay? Your pro trader tip for stocks that traditionally move and move big around their earnings, okay, is what we're going to look at today. So trade ID 1164. This is Oracle. You know, I like to bring you the latest trade updates here on Pro Trader Tips. This is a trade that I sent out yesterday on the 11th of June. We took it off today on the 12th of June. So this is hot off the presses here. Let's go back actually to the 10th. Sorry, my bad. 2 days ago. Got all excited there. But let's look at the trade that it went out here. This was a straddle on Oracle. Okay. And we are looking at essentially buying a call and buying a put at the same strike with the same expiration date. And this is straddling the stock. Now, what you want to do here, and this is where a service like our Delta Neutral Breakout service comes in handy, because I do all the research for you. Okay, but what you're going to want to do if you're not a subscriber is, number one, either subscribe, or number two, do it yourself. So if you do it yourself, here's what you got to do. When you see a stock like Oracle, you need to look at the historical average move that this stock makes. All right. And then you have to calculate what the option market is telling you what the estimated move is going to be. And sometimes we get an edge, meaning option prices are in line with with the current market, but the historical move of the stock is greater than that. And that's exactly what happened here with Oracle. All right, we were able to get that edge. The options were cheap enough for us to go ahead and purchase in anticipation of a bigger move than what the essentially option market was looking at. And so we sent out this alert, and you can see here in the risk graph, okay, stock is on the left, the risk graph is on the right. This is where we're visually seeing the straddle. That's in the black line. If you look at the red line, it's coming in contact with this black vertical line, and that is essentially zero, meaning we just put the trade on, and the price that we paid was $9.30 on this, and we got the fill. So then we move forward, and yesterday I sent out this alert. Okay, so I want to send out alerts. This is after market close yesterday when the stock reacted. Okay, and as you can see here, Oracle was up in after hours trading pretty significantly. At the time, it was up over 9%, almost 9%. And I sent out this alert saying, hey, we're getting a reaction out of Oracle. Be ready to take the trade off in the morning, okay, which was this morning. And so we watched the market open, watched the opening rotation of trading go on. And then here I have narrowed down the chart to a 3-minute chart. So where the white part of the chart, you'll see this bluish area, that's pre-market, okay? And then the white, we get into open trading. So these are 3-minute bars. So 3, 6, essentially about between 6 and 9 minutes after the bell, I sent out the trade alert to say, take your profits. We're going to exit this trade. This exceeded that upper break even of the risk graph. In fact, let me show you that. Now remember this price, 139.01, okay, when the alert went out. And if we go back to our original trade, okay, the alert, look at where it says up in the upper box in the upper right, at the towards the bottom of that box, you'll see where it says upper break even is 134.30. All right, 134.30 is where we needed this to go. And in the aftermarket trading, it was trading up at 139. And then this morning, we sent out the alert to exit the trade, okay, at that 139 and change. The call options were well in the money, and we were taking our profits at that time. And in the end, here are the results. All right. So we had the straddle. Now it does say long strangle here. That was an error on my part. I didn't kind of refresh the strategy. But when the trade went out, you see 125 call, 125 put. That is a straddle. And the profit that came in, we exited at 1426. That was the price we exited at. And that was a profit of $496, a 53% return in a little over 24 hours. Okay, a little over 24 hours. The way this clock works. Okay, put the trade on, and if you take it off the next day, if you put it on at 1 p.m. on one day and take it off at 10 a.m. the next, that's actually 0 days. It's a 24-hour clock. So that's how it calculates that, just so you know. All right, but so in the end, for your pro trader tip of the day is around these stocks that typically move or in a sector that has the potential to move, just calculate that estimated move, see if the options give you that discount on the pricing. And if they do, you got yourself a potential winner. That's your pro trader tip today, taking a straddle on a high performing stock. If you like this, give us a like and a follow. I will talk to you next week with another pro trader tip of the week. Everyone have a great trading week. Take care.